Good morning, good afternoon, and good evening. Today, we'll look at financial analysis, how to analyze financial statements for your company, or just a question in the exam. How do you tackle it? There will be some series of lectures or videos that I'm going to produce. This is just video 1 on financial analysis, more theoretical. Then video 2 will actually go slightly in depth. As an organization or a person that works in that organization, you should actually be interested in the financial statements or annual reports or integrated reports that your company generates. We should not leave these documents only for accountants. There are basics that we have to understand. For our personal consumption and subsequent our informed decisions. If you look at the income statement, all you're actually seeing there is a representation of what happened in that particular year. So in short, it looks at the performance of the company. You can do a number of analysis, whether vertical analysis, horizontal analysis, bringing trending just to give you an understanding of where your company is heading to. So there will be a number of ratios that you have to get hold of. Performance ratios, liquidity ratios, gearing ratios, working capital ratios, investors ratios. What are those key metrics that speak to these respective stakeholders? So ratios that are actually focusing on the income statement, they are performance ratios. There might be a bit of some hybrid with the numbers that you get. Good, I'm good. Sorry for that distraction. So all the ratios, all the numbers, if you are looking at ratios that are focusing on the income statement, those are performance ratios. This is why you say for the year ending, when you are referring to the income statement, to the balance sheet is as that. But there would be some certain ratios that actually they're performance ratios, but they are picking some numbers from the balance sheet. So it's a hybrid of the income statement and the balance sheet. There will still be performance like asset turnover ratios, return on capital employed, which is ROCE, or ROI, return on investments. Those they look at the performance of the company. But then there will also be certain ratios that will look at liquidity. Like we always say, liquidity, cash is king. So there will be those ratios. But those ratios, they will actually focus on the balance sheet. They cannot go to the income statement. And the reason is simple. The income statement is based on IFRS, on the accounting standards, whether it's GAAP or IFRS. And they are based on accruals concept or matching concept. that revenue earned must be matched against expenses incurred in earning it. So it's not cash. So if you want to know the liquidity of the company, or let me give an example, the liquidity, your liquidity as a human being is not based on your day-to-day runnings, your day-to-day operations, your salary, what? No. It is based on how much cash do you have, or that which can be easily converted into cash against your immediate obligations. That is an issue of liquidity. So what are those immediate obligations? You have to actually pay the Inland Revenue Authority. You have to pay your creditors. That is immediate. You have to pay your short-term loans and all that. That is immediate, and it needs liquidity. It's not profitability, it needs liquidity. Then we also would find ratios that are focusing on debt. You would want to know the DE, the debt equity. How is the mix between debt and equity? You would want to know debt over equity plus debt, and this is interest-bearing debt. You would want to know if you have the ability to actually pay interest. So you will need to do your interest cover. You would also want to know whether you still have the ability to pay your interest and loan amortization, meaning the principal repayments. That then you have to look at your debt service cover ratio, which would be your EBITDA divided by interest plus principal. You'd also want to know on your current debt, how long you would actually take to eventually or to fully amortize the loan. The lenders may require you or may test your ability through a ratio called debt over EBITDA. EBITDA is earnings before interest, tax, depreciation, and amortization. So if it's annual, you're actually looking at your annual EBITDA, which is just your net operating cash, into your debt. The minimum, depending on the industries, for bigger utilities like electricity utilities, it will be 6 and below. For retail, it would actually be 3 and below. Sorry. Okay, so let's get into the presentation for a fuller understanding of the financial numbers or financial data. So you start with financial performance. I already explained a bit, but let me just explain on gross profit margin. It is one of the key metrics that you as a financial analyst needs to actually look for, because it does factor in the direct costs. These are costs that are directly attributable to your core business, to your core product. So if your gross profit margin is going up or increasing, you should start getting worried. It could be that you have started giving discounts on your sales. Your sales have started going down. You need also to check on your sales. At what level are your sales growing? vis-a-vis the growth of the cost of sales. If, for example, your sales is growing at 5%, whereas your cost of sales is growing at 15%, your gross profit margin will start going down. So those are the things that you have to look at. And the possible reasons shall always come from revenue or cost of sales. If, for example, your gross profit margin is going down, it's either your revenue is not growing at a rate at which the cost of sales are growing. So the question will be, why? Have you started giving out some discounts? Yes, the volume of sales is growing. The revenue is growing, but it's growing at a slower rate. Maybe because there are certain incentives that you're actually giving to your customers, maybe carelessly. So have you introduced a new product? Yes, you're heavily marketing that product, but it hasn't attracted so much traction. It is not doing good. So you need to invest more in advertisements. Have the cost of materials gone up? Maybe if you're in a country that is heavily dependent, on imports. It could be that the costs are being influenced by the FX movement, foreign exchange, currency movements. Could it be that you have employed so many people in the production department, therefore influencing your direct labor costs going up? Is it that the key people that you had have gone, and now the employees that you have employed, they are not skilled enough, and the costs suddenly are going up? Have you started to outsource? Apparently, you did not do a cost benefit analysis when you're making a decision on outsourcing. It has been discovered that it's now more expensive. Why are you cutting the prices? It could be that you've started cutting the prices for a simple reason that you have so many competitors. You want to compete with these competitors, but you think that you have to focus on cost, on the pricing, rather than the quality of your product. You want to reduce the price of your product so that you can increase the customer base without increasing revenue, or the revenue is not going to increase at the rate at which your cost of sales are increasing. What is really happening? This is why you need this gross profit margin. It's a very important metric. Even when you're doing this, you have to compare it with the previous year. You can do that. You can compare it with your competitor. You can also compare, even when you're comparing the previous year, you can still compare using the vertical analysis, or you can go horizontal. You can compare with the benchmark, which could be the industry standard. We have picked 4 or 5 companies within your industry and averaged the gross profit and compare it with yours. So there are a number of these causes that are on the slide, I'm sure you've read. Then now you go to operating profit margin. On this one, you are looking at profit before interest and tax added by revenue. From one kwacha or $1 revenues that you're generating, how much operating profit are you making? I've always said the focus should not even be so much when you're looking at these numbers. It should not be so much on revenue. We hear companies say we are a 200 million revenue company. We're 400, but what they should actually be saying is we are maybe a 200 million EBITDA company. We are a 30% EBITDA margin company. That makes a lot of sense. Then you can have so much revenue, but your costs are actually could even be above revenue. So it's not a number that you should actually use. It does not mean anything at all. So this ratio would differ fundamentally from the gross profit margin because then it includes things such as admin costs, selling and general expenses. So it shows, for example, on gross profit margin, you seem to have actually been moving at the right level. Then the operating profit margin in that particular year actually dips going down. It means that there are certain costs, unnecessary costs that you are actually incurring. Maybe they are not unnecessary. Maybe there's a new product that you have launched on the market. It hasn't yet gained a lot of attraction. And you have invested so much in advertisements. You have brought one of these social media celebrities or Facebook celebrities, they become your brand ambassador and all of that. So that is a cost on its own, which will affect the operating profit margin. But if you are looking at these numbers and analyzing them nicely, you actually see where the problem is. Return on capital employed, ROCE. Others would actually call it ROI, return on investments. Here, what you're actually doing is that you are trying to test on whether the investment that you have put in is generating a meaningful return or operating profit, which is the PBIT. How effective, how active is your capital involved in generating your targeted returns? These returns, ideally, if you don't have any other benchmark, you can still use the internal rate of return to benchmark with your returns that you're making, because obviously if you have a ROS of 10%, yet maybe treasury bills are giving you 16%, why not go for treasury bills? Come in.